I couldn't help but start in the break because I'm always curious. You know, you got one person saying this, another person saying that, somebody saying something else. I don't know. But markets have been rough since the 1st of August. Stocks and bonds going down at the same time, apparently, right? Tell me about this.
Yeah, the correlation between stocks and bonds, meaning them moving in lockstep, has been just awful over the past 3 months. You know, stocks have been down about 8% from the summer highs, and bonds have been down about 6% since the spring highs. And so that makes it really challenging for an aggressive or conservative investor when both are going down at the same time.
My money market's not down. I'll tell you that. So, you know, somebody gave me good advice on a money market. His name was Nick Hopwood, by the way. And that hasn't gone down. So there are places you can hide from the storm, aren't there?
Yeah, good point. You know, we've been beating that no lazy money market drum for over a year now, and now the yields are, you know, over 5% on money markets. But that's a short-term place to put money, right? I look at that as somewhere for your emergency fund or money that you need over the next year that cannot be put at risk. But if we're investing for longer time, you know, a couple years plus, you know, think 5, 10 years out there, I don't think that those money market rates will still be around because the Fed will probably cut rates at some point. In fact, the market thinks the Fed will cut rates as quickly as June of next year. So those money markets won't last, but if you're locking in your 5 and 10 year bond funds yields of over 5 and 6%, you know, I think those numbers will last much longer.
So if it's the 6% bonds, how long do you have to lock in for? Average, just thumbnail. I'm not going to put it on the test or anything. I'm just curious.
Well, we recommend you know, mutual funds and ETFs that have daily liquidity. So technically, you're not locked in, but they do own thousands of different bonds inside those funds, and the duration could be several years.
Several years. And see, that makes a lot of people, makes me nervous, makes a lot of people nervous. If you see an opportunity to go pick up a piece of real estate or something and you're locked in there, then you can't do that. That's why I like the liquidity. I agree with you. Huge deficits in the debt. I mean, we talk about this a lot, Nick. It doesn't get any better. A new war out there now, of course, and they want to dump a pile of money into both wars. They want money for Ukraine, money for Israel, money for more weapons here in America. I mean, how deep can we go? We're 33 trillion in.
Yeah, it's disturbing, you know, and I think that, you know, it's getting more and more attention, especially with the yields coming up from 1% to 5% over the past couple of years, and the amount of debt service that comes out of the budget as a result of the large debt and the large interest rates, the higher rates. So it's garnering more attention. No one really knows, you know, where the breaking point is, but it is extreme. And you know, the way that I talk with my clients about this is, you know, the taxes probably will have to go up between now and retirement. And so let's play the long game. Let's play Roth IRAs, Roth 401ks, HSAs. Let's take advantage of the market being down and do some Roth conversions. And, you know, even if you're at a high rate today, the rates will probably be going up at some point in terms of taxes. So that's the way that I approach that.